Is the US housing market getting ready to snap? That is the question that a lot of people are asking. And today on this report, we will attempt to answer that question. Before we get started, please give us a like if you like what we talk about here to get this video a little bit of traction, hopefully. Let's go ahead and jump right into it. We have some pretty dire news out of the housing market. Let's bring this up here. This is out of CNBC. December home sales slump close out the year the worst since 1995. December home sales were 6.2% lower than the same year or the same month a year ago. Inventory fell 11.5%, so less houses available. Now that was from November to December. We're going to talk about inventory here, more on that in just a few minutes. Home sales came in at 4.09 million. That's the lowest since 1995. Now there were theories that by this time, at this point, there would be a lot of home owners desperate because of the cost of living, the cost of maintaining a home. The theory was that a lot of those sellers would start putting their homes on the market. So we haven't seen that yet. We haven't seen that flood or that tsunami of homes hitting the market like many people had predicted, especially with the mortgage rate so high. A big reason for that is because rents are still very high. So the alternative to owning, of course, everybody knows it's renting or living on the street somewhere in a tent. But not counting that, the alternative is renting or living in your grandma's camper behind her house. Other than that, and a few other things I can think of that we won't go into. Other than that, the alternative to owning is renting. And is it a lot cheaper to rent right now? In some areas, it's a little bit cheaper, but in a lot of areas, and I would say in most areas, it's not much cheaper at all because rents are very high. In fact, rents are correcting a little bit, but we saw a massive spike in rents, especially since 2020. And now it's not an attractive option or as an attractive option as it used to be, compared to owning a home. Because, why would you sell a home when your mortgage is 1,200 when you have to turn around and rent the place for $11,199, right? You're going to save a dollar on rent, right? I'm exaggerating a little bit, but you see the point. In some cases, doesn't make much sense to sell if you're going to be paying just as much or almost as much in rent as you are owning the home. Now, the other theory was that homeowners were going to be so afraid of declining home values that they would rush to put their homes on the market. Again, we haven't seen that yet. But once that does start ticking up there, once price declines start hitting the media and the news, more homeowners take notice. But you have the rent versus owning cost ratio you have to consider, and lots of other things that we'll talk about here later on in this video. Well, let's get into some other information here. And we are going to stay on the topic of housing for most or all of this video. Let's talk about home prices. Home prices have come down. The median price of existing single-family homes, also includes condos and co-ops in the U.S., closed out December $382,600. That's actually down about 7.5% from the peak. And I have to correct myself because in my last report or the report before that, I said that the peak was in August. Pretty close. It depends on what index you're looking at. If you look at the National Association of Realtors Index, the peak was technically June 2022. It's actually different if you look at the Redfin numbers. Anyways, it's close to there, June, July, August, the peak. So down 7.5% from the peak. Now, when you look at it year over year, it's interesting because prices are actually barely up year over year, but down from the peak. So we'll have to keep a close eye on what happens this spring and this summer. This puts 2023 on record as the first year since the housing bust, 2007, 8, 9, when the seasonal high in June was below the seasonal high a year earlier. Given the price surge in spring 2023, the median price was 4.4% higher than in December a year ago. So when you factor in the price surge and look at the peak, prices are down, which is definitely significant, over 7.5% of a price decline. Also, in a kind of eye-opening development here, prices have dropped every month since last June. So since June 2023, prices have dropped every month. We're not seeing the crash like some people had predicted, many people had predicted, but we are seeing prices decline and weakness in the housing market. So we'll have to see how this plays out. And in fact, if you go over to Wolf Street, you'll see a chart of the median price. And if you look to the right edge here, you'll see what appears to be a double top. If you follow my cursor, a double top in prices. And we'll see if this summer, picks back up or not with peak home buying season. If it doesn't, that could be another sign that we are at or near the peak. Now, the other wild card out there is rate cuts. Are rate cuts on the horizon? And even if they do cut rates, will that be enough to rescue the housing market? Well, typically, if you look back at history, even the housing bust 2007, 8, 9, lowering rates back then didn't rescue the housing market. Eventually, home prices dipped and started coming back up, but that took several years after they dropped rates to near zero levels. So could something happen like that this time? Of course, but the question is, how big of a decline will we see before that were to happen? Now let's go over and take a look at a chart here. This is some Fred data, and let's look at inventory. This is very important. We saw inventory spike up in the summer and going into the fall and winter of 2022, over 750,000 homes for sale. And then we saw it drop. And then we saw last year going into winter, it actually went up just past what the peak was in 2022. So just about 755,000 it peaked out. Of course, it went back down here as of last month in December, but it didn't dip down like it did in 2022. So that's another sign that inventory is starting to form an upward trend or an upward trajectory. And that's very important. That's a sign that more homeowners are getting desperate, more homes coming onto the market, more new construction coming onto the market. And what we're seeing here is they're a lot of times having to incentivize buyers to come in and buy these homes, especially new homes. We're seeing home builders now offering a lot more perks and incentives and, of course, price cuts to get people in to a new home. All right, so this spring and this summer, again, is going to be the telling sign of where this housing market is headed. And going back to this chart real quick, the reason this is significant with the seasonal uptick or year-over-year uptick in inventory is because if we go back all the way to the beginning where this chart takes us back in early 2017, every year it was lower and lower and lower and lower. And of course, a huge drop in inventory after 2020. And now we're starting to see things level out and even increase and go up year over year. So definitely something to keep an eye on. Let's go ahead and get into some other news here, though, and shift away from housing here for just a minute. Something about the cost of living and prices I wanted to talk about here. And there's been a lot of finger pointing and people trying to pinpoint exactly what is causing the cost of living. Of course, we have the money creation. We have the fact that the banks are being propped up and emergency funding programs are being funneled into the banks. But take a look at this. This is out of The Guardian. And basically, here's what they're saying, is that a lot of this is greed and price gouging. Half of recent U.S. inflation is due to high corporate profits. High corporate profits. While there's always been greed and there's always been the desire for corporations to maximize profits, well, ever since 2020 and the supply chain issues that we saw, a lot of companies and businesses are using that still as an excuse or as a reason to keep prices elevated. So when you have this excuse or when you have something that everybody knew about or everybody realized that there were supply chain issues, you have the reason for companies to do this and therefore be greedy and price gouge without feeling as guilty, because you can always say, oh, it's the supply chains, it's part shortages, and then you can just blame inflation, or we have to pay our people more, so therefore we have to raise our prices. But when you look at profits, a lot of this was price gouging and it was greed. Speaking of price gouging and greed, one of the factors here that we have with the high cost of living is people demanding higher wages. And let's take a look at another recent report here, and we'll see what's happening over at the LA Times. LA Times doing a protest, also known as a walkout, protesting anticipated layoffs. And you've got a picture of some of the Times employees here. And you have to wonder, will holding a sign actually stop you from getting laid off? I doubt it. I guess they're expressing their rights, or they're flexing their rights, or using their rights to protest. But do you really think that whoever is in office there, whoever's the head of LA Times, do you think they're going to look at this and they're going to say, "Wow, these people are out there holding signs. Maybe let's not lay them off"? Do you think that's actually going to happen? So, does this do any good? Do these protests or these strikes, do they do any good? Walk-offs, maybe, because if the company can't find people to replace you, and all of a sudden now you can't put out product, in this case you can't put out newspapers because everybody walked off, that may be a little bit of a negotiating tool or a tactic, and we'll see how much leverage these people have. But usually it doesn't result in any sort of change or reversal in a company's decision to go ahead and lay people off. So I think it's kind of silly, but maybe I'm wrong. Please let me know what you think down in comments. Are these people going to make any leeway out there holding signs, and signs that say "Don't cut our future"? Right? Are they wasting time, or should they use this time to maybe go find a different occupation in an industry that's not dying, like the newspaper industry? And it doesn't stop there. Other dying industries are also laying off, and I'm talking about print media and specifically magazines. What are we seeing here out of the Times? Sports Illustrated thrown into chaos with mass layoffs. The announcement came Friday, and this is going to be right around 90 days. They're going to begin to lay people off. My question is anybody surprised at this? I mean, if you go into Barnes and Noble bookstore and other bookstores, they still have a pretty big magazine rack. Even Walmart has a magazine rack. So magazines still have their place for people that don't like to just stare at a screen all the time and be on their laptop or on their mobile device. But definitely a dwindling industry. And when you look at Sports Illustrated, is the swimsuit issue that good? I mean, it only comes out once a year. But by the time you get print media, sometimes it's outdated by several days or even several weeks or even months. And you can read more current news, of course, daily, fresh news on the internet. So it's really surprising to me that these print media companies, magazine companies, haven't laid off more people. Does anyone still read magazines? Actually, I do at the doctor's office, and I probably shouldn't, because the people reading the magazines in the waiting room are probably sick. So it's probably a bad thing to read magazines at the doctor's office. Anyways, speaking of layoffs, Wayfair, huge layoffs. The Amazon competitor laying off 13% of its workforce weeks after telling employees to work harder. This one's out of CNN. Wayfair is laying off 1,650 employees. That's about 13% of its global workforce, as the online home goods retailer struggled to rebound following its success just after 2020. The CEO, who recently went viral for telling his employees to work harder, said in an open letter posted Friday, quote, "Wayfair went overboard in hiring during a strong economic period," referencing 2020. Remember when people had all that extra money to spend? Nobody was traveling because of the shutdowns and the lockdowns. People had time and money, extra money to spend, and they caused an economic boom. They caused retail to really take off. But then now we're seeing the fallout from this. And the question is it going to stop? Well, it's very unlikely unless they find a way to erase all this credit card debt that most people are burying themselves under. Now, let's talk about the stock market. We see the S&P 500 hit an all-time high just after this recent historic bull run. Will we continue to see the stock market climb and climb and climb? I like to remind people here, I'm not predicting a crash. What I've said is that the economy is based on how much money people can borrow. If people could continue to borrow money, you'll continue to see economic activity. And I don't think you're going to see any big stock market correction if this continues. If the banks start dropping credit limits on credit cards and start making it really difficult to get a loan, economic activity will basically then drop off of a cliff. And that's when you'll see the stock market react. That's what it's all about, folks. It's all about the debt markets. It's about the ability for people to borrow money to continue to go deeper and deeper and deeper into debt. Now, some people say, well, it doesn't matter if the credit card companies increase the credit ceiling, because if people can't make their credit card payments, then that's going to stop the ball game anyways. It's going to stop people from being able to spend if they can no longer make their payments. And it's getting more difficult for people to make their payments because rates are still high, and debt levels are still climbing overall. But if somebody can just file bankruptcy, or if millions of people can file bankruptcy and just go out and get a credit card a month or two later, you may not see much of a slowdown in spending. So even with a lot of bankruptcies and people hitting the financial wall, you have to have a pullback or a slowdown in the spigot of money that's being created and loaned, also known as the debt limit, or in this case, the credit ceiling for credit cards and loans. All right, so that's what it's all about, folks. Keep an eye on it, because I hear some of you, I see some of your comments basically saying, JJ, you need to pick a side. One minute you say it's going to crash, the next minute you say it's going higher. Folks, it can go either direction. It's all about what the economic engineers decide to do. That's one of the main things about this channel, is that I don't think anybody knows the direction. We see people that have been analyzing markets for decades, billionaires, get things wrong every year. And I can put names out there of very well-known people that have been predicting a crash for years, and they've been wrong. Why? Because it's impossible to predict what these people that engineer this economy are going to do. You can listen to what they say, but then the very next day they'll turn around and say the opposite, just like the rate cuts. One day we heard that there's likely going to be a lot of rate cuts in 2024. Then we had another individual from the central bank say no, there's not going to be any rate cuts. We're still focused on inflation. So you can listen to what they say, but do you really believe them when they could just change their mind the very next day, or completely contradict themselves the very next day? In other words, it's impossible to predict exactly what's going to happen. This is all about odds, probabilities, and what are the odds? What are the odds that they're going to let the market crash this year? And some people say, well, even if they try to keep it propped up, it's just going to crash. It's out of their control. I don't think so. If they can have enough money pumped into the economy, if they can keep the banks propped up with emergency lending, maybe even send out stimulus checks, cancel foreclosures, cancel car repossessions, all those things that people thought would never happen until 2020 rolled around, those things are possible. Will we see something so big happen where even those things will not save the economy? Of course, it's possible. And I think if that does happen, we're going to be looking at about the March timeframe. After March, so close to the end of March, I think that would be the timeline if I had to put a timeline on it. And again, this is just putting the odds on things. And I can't really say why I think it's going to be at the end of the month of March. But I think in a few short months, you're going to see some really, really surprising things happen, and some surprising information come out. That's all I can really say about that. So everybody, please let me know what you think about this. Back to the beginning of the video, the home inventory rising up slightly year over year. What do you see in the housing market this spring and this summer? Also, what do you think about these layoffs, the people protesting from the LA Times newspaper? Are they going to make any headway and get any leverage out of protesting and walking off the job? What do you think about the layoffs coming out of Wayfair and Sports Illustrated? Is it a sign of the times? Is it a sign of more things to come? Please let me know down in the comments. I will be reading your comments. As always, everybody, we're going to wrap this one up. Keep stacking. I will probably talk to you this weekend. Big love, everybody. Bye for now. Peace.